Amid a budding surge in long-term rates, the US Treasury surprised investors last week by upping the size of several Treasury auctions taking place this week, including a $42 billion auction in the 3-year tenor at 1 p.m. today. Now, for the latest, we turn to Yahoo Finance's Jared Blikre. Hi, Jared. I know you're covering all of this for us, so where do things stand?
Yes, a lot happening in the bond market recently. And as you just said, we have a $43 billion auction, or 42, in the 3-year tenor. That's coming up in an hour and a half here. But we also have a 10-year auction tomorrow, a 30-year auction Thursday. Altogether, that's $103 billion that's only bonds. When you take into consideration what's happening in T-bills, that's an extra $222 billion. So that's a lot of cash that is being sopped up. And as you also said, the auction sizes for a lot of these have been increased. And this is coming at a kind of precarious time of year. I'm going to get to, let me just show this now. This is bond market seasonality. So this has to do with the liquidity in the Treasury market. And as you can see, here's August. We got January through December. August takes a dip, and usually what happens when you have lower liquidity, that means increased volatility, and that of course means some hinky price action. Now, it's not always like that, because as you'll notice, December is by far the worst month for liquidity. That takes into consideration the Santa Claus effect, when a lot of nothing tends to happen. So it's not always bad, but when you take into consideration too that we tend to go flat in equities this time of month or this time of year in August, and we also have the VIX seasonality. I was showing this in an earlier hour, that VIX seasonality points to an increase in the VIX. Well, you put it all together and we have the makings for a little bit of a sell-off here. So let me show you the VIX. This is in equities. This is the fear gauge. You can see we have now hit today the highest level in 2 months and maybe a week or two. Here is the VIX of the VIX, the third derivative, fourth derivative. That's spiking up a little bit as well. And what I like to show is the ICE B of A move index. This is bond market volatility. This is as of the close. So yesterday we retraced to the downside. That's that red candle, the movement to the upside, but it was a breakout, and we're going to have to see what happens today later on. Finally, I just want to show you what's happening technically in the 10-year T-note yield. You'll notice, and this was the surge you were talking about in the intro, we got pretty quickly back up to over 4%, and we're holding the 4% line right now. Let's take a look at what happened over the last year when we reached that 4% mark, and we've done it 3 times. So you go back to last October, last November, we got a downdraft after peaking above 4%. Then in March, we did a similar thing, and that was right around the internet banking panic. And then recently, we got a little bit of a sell-off here, but we're back up again. And so I think if we break this trend line to the downside, it's going to be about 3.8, 3.9%, probably in line for another decrease in these rates. But if we keep going up here, there's going to be a huge surge. You could call it a short covering rally if we were to go materially above 4%, and we could get back to 5%. These are levels we have not seen in quite some time, Rochelle. So some pretty big catalysts on the horizon.
And certainly a big week indeed for the bond market. We know you'll keep us honest with all of that. A big thank you there, our very own Jared Blikre.